Welcome to Fundu Money, your 24 into 7 buddy in all matters related to personal finance. This particular segment, or shall I say that this particular web series, is discussing various things that you need to keep in mind while investing in stocks. And in this segment, we are going to talk about something that has become a buzzword. It's a larger factor which impacts stock markets, but it's become a kind of a buzzword in the past couple of years. That's right, we are talking about commodity prices. Now, every time somebody talks of the economy, about a future, the way our economic prospects are there, and of course, how stock market prices are going to behave, or how stock market investments are going to do, people are talking about commodity prices. Why is it so important? Well, we're going to decode some of the essential things that people need to know. That's coming up shortly. Falling commodity prices, rising commodity prices, these seems to be the kind of buzzwords sort of going around for quite a few years now. Now, how does it really impact a completely different market, which is the stock market? It's a different market where you buy and sell shares. To figure this out, we have got with us stock market expert Mohit Satyanan. Hi, Mohit.
Hi, Udayan.
Mohit, this is a commodities market, from dal to crude petroleum to gold and what not you have. Everything gets traded in the commodities market, international commodities market. More and more of us Indians are getting used to hearing about it. How does the fortunes, going upswing or a downswing, actually impact stock markets in India, share prices, shares, and what is the link, and what should an investor be looking at? Is it just noise, or there's something important out there?
Most of the time for a lay investor, commodity prices is just noise. Okay, I think the exceptions are when you have dramatic spikes. Or dramatic falls.
Mm-hmm.
Now, dramatic falls matter a lot when you own shares in a commodity company.
Okay.
So, if, for example, you own shares in a company that exports iron ore,
Mm-hmm.
The fortunes of that company are directly related to the price of its product. Its product is iron ore prices fall, the profitability of that company falls hugely because the cost of its labor is not falling, the cost of electricity to run the machinery that extracts the ore is not falling, the cost of shipping the iron ore to overseas markets is not falling, etc. So for companies like that, dramatic drops in commodity prices obviously play a critical role, and these companies can turn from huge supernormal profits to massive losses within one financial year.
Sure.
Okay, so that's clearly a caveat that you need to be looking at. Huge and sudden spikes in commodity prices impact the fortunes of those companies that consume those commodities as inputs. To take one example, supposing I run a company which manufactures snack foods, and a significant component of my cost is the plastic packaging in which the snack food is sold. Now, plastic is a petrochemical, and the price of petrochemicals is related to the price of oil, crude oil. If the price of crude oil goes from $40 to $140 in the course of a year and a half, it suddenly changes the economics of my production. And I can't alter price to the consumer so drastically, so rapidly. And so for a while I go through a huge margin compression. And that means that my profitability suffers. And this would be true of the spike in commodity prices of any significant input into what I am manufacturing. So yes, we do need to look at commodity prices. But with the caveat or the exception of commodity prices, I have a slightly different theory. I have a slightly different way of looking at it, which is that to go back to the example of snack foods, what really matters to me as an investor is whether this company whose shares I own has pricing power or not. Meaning, do the customers like its product enough that in the midterm, meaning over a year or two, that the company can adjust its prices so as to preserve its margins. Most companies are able to do that.
Okay.
They're able to do that. So you have these temporary aberrations. You know? So for example, if the price of, again to look at petroleum products, because that's our biggest import and that's where we as a country are most vulnerable, it could take up the cost of plastic packaging. It could take up the cost of the input into paints, for example. And it does mean that there's a margin compression for a paint company. But over a few quarters, that all rights itself. And what typically happens when you have these kind of disruptions is that the weakest fall. So you may have a company which is in any case not been growing well in the paint sector, and it drops out. In the medium term, the number of houses in India is only going up.
Yeah.
The frequency with which we paint our house is only going up. The average room size is probably going up. And therefore, when this kind of disruption happens, the more successful company is going to grow. And these become opportunities if you keep your cool and if you remember that in the medium term, companies can bring their margins back to a healthy level. Most commodity price spikes create an opportunity for entry. And I would much rather look at which are the companies that will be able to survive this this disruption and get in and buy stocks of those companies at that point in time.
Well, that's a very interesting perspective Mohit has given. Just in case you have a different take on this, well, go right ahead at the comment section and type in your comments. If you have a suggestion, please feel free to give your suggestions. If there's a content, a topic that you would want us to create, we would love to do that. Apart from that, if you've liked this video, please go right ahead and click on the like button. Apart from that, we would love to have you subscribe to our channel, and of course, please stay connected with us on all leading social media platforms.